entire passive category in India accounts for nearly 5 lakh crores in terms of assets. Of this, the bulk, that is about 4 lakh crores, lies in ETFs. About 50,000 odd crores is in index funds, and then a minuscule 20,000 odd crores in fund of funds. So here's how the three passive categories differ from each other. An ETF or exchange traded fund is a set of securities which tracks an index of shares or a commodity, bonds, and so on. Basically, ETFs can be for any asset which has an existing index. Some specialized ETFs also create their own curated index where one doesn't readily exist. Now, when we say ETFs track the index, what we mean is mirror the index. For example, if an ETF tracks Nifty 50, then it must hold the same stocks in the same proportion and tracks the returns of its native index, the Nifty 50 in this case. This type of fund cannot and should not outperform or underperform the index to which it is pegged. It has to simply replicate the same. However, an ETF's returns will always be a shade lower owing to the management expenses. But for most ETFs, this is almost a negligible charge. If, however, an ETF's performance varies greatly from its index, it means there is a tracking error or the securities are not being rebalanced efficiently to reflect the changes in the index. Index funds are similar to an ETF in every respect except two. The biggest advantage of an ETF is that they trade on the exchanges and are priced throughout the day. But index funds, like any other mutual fund, get their NAV at the end of the day. As well, you need a demat account to invest in ETFs, whereas one can invest in index funds directly through an AMC. Fund of funds, however, are a different ballgame altogether. The basic premise here is that they hold a basket of other funds and hence the name of fund of funds. This strategy is often called a multi-manager approach, and investors use it to diversify risks from a single scheme or fund manager. Here, the underlying is not a stock or commodity, but the mutual fund schemes of other fund houses. However, fund of funds is a much costlier bet compared to its other passive cousins. This is because the AMC offering the fund of funds will levy its own charges on top of the costs associated with each underlying fund itself. In some cases, this can be close to 2% or more, something which will naturally dampen the returns. This is a major reason why this category has never really taken off. The other thing to remember is that fund of funds are taxed like debt funds and not equity funds, even if they invest in equity schemes. So if you're a new investor, you can consider investing in either of these categories to get a wide exposure to the market and then build your portfolio from there.